Good evening. Welcome to Moneyfarm's webinar on current market volatility. We'll just wait a minute or so for everybody to join, and then we'll get underway. Quick reminder, as always, these webinars are recorded, so if you miss anything, we'll distribute it afterwards, but it's always available. Having said that, it's 6 o'clock on the 14th of April, so things are changing very quickly, so just bear that in mind if you're watching something back, but we'll try and address as much as we can for now, and a lot of what we talk about will be quite evergreen anyway, so still very, very useful. Very good. I think we're good to start. So thank you everybody again. Thanks for joining us. This is our, let's say, reactive webinar in response to what's going on in the markets at the moment. For those who aren't aware, which I can't imagine there's a lot, Donald Trump, President Trump, recently on Liberation Day, announced sweeping set of tariffs, many of which the magnitude of which took the world a little bit by surprise, and this has caused quite a lot of market chaos and a lot of volatility. We'll go through that in detail, share our views, share how we're thinking about on the portfolios, and specifically answer a lot of questions or any questions that you might have on the situation. I've seen a question come in about recording. Yes, Jane, this is recorded and we will share this afterwards. Very good. I'm joined tonight by Richard Flax, our Chief Investment Officer. I am Chris Rudden, Head of the Investment Consultants, so Head of the Client-Facing Division. So anyone who's spoken to some member of the team in recent days, this is the team that's my responsibility, and hopefully we'll be able to expand on some of the conversations that you've been having with them as well. Normally, obviously, we do many webinars. They tend to be, I think hopefully this one will be a little bit less, let's say, structured. We will, up front, we'll kind of share our views on what's going on. Richard will give a view on how we're looking at things, what we're looking at. Give a view on the portfolios, so the investments that we're managing on your behalf. Where are they at the moment? What are we thinking about what we might do next? I will then say a few words about, as an individual investor, how should you address this situation? And again, probably coming on a lot of questions that we've been receiving over the last couple of weeks. I'll try and bring all those together and answer those as best as I can all in one. But crucially, I think this time around, we'd like to spend more time than normal on questions. We've had plenty of good questions up front as well from you guys, so that's great. And below at the bottom, you'll see a Q&A box. So if you type any questions in there, we'll try and pick up as many as we can, the two of us live. But we've also got members of the advisory team and of the portfolio management team on the Q&A chat as well. So they will be responding to questions as they come through. And then any that we don't pick up between all of us, we'll try to come and follow up afterwards one-to-one. So, Richard, over to you.
Great. Thank you very much, Chris. Thank you, everyone, for joining. So I'm going to do a couple of things. I'll talk about where we are and a little bit about how we got there. And we'll talk about portfolios, as Chris said, how we're positioned, what the sort of discussions are like within the team, within the investment committee at times like this, and then give a little bit of a sense about things that we're thinking about, things we might do, depending on how markets behave and how the overall environment develops. So let me say a couple of things. The immediate focus here has been, as Chris mentioned, around trade tariffs raised by the US on its trading partners, tariffs that were pretty well flagged during the election campaign and subsequently, but still when they were introduced were perhaps higher than investors had expected, and we saw volatility as a result. I guess there's two things to say at the outset. The first is that we really think about trade tariffs as a tax on consumers, and as something that is likely to slow down economic growth and potentially raise inflation, at least in the short term. The second point, I guess, to make is that the way that the US administration has been announcing or implementing these policies has created a lot of uncertainty. You've seen announcements, you've seen policies walked back, then reinstated. And that makes it very difficult for businesses to make decisions, for households to make decisions, and obviously for investors to make decisions. And this slide here that I'm showing really tries to capture that. It's an index of economic policy uncertainty, measuring media articles and media analysis, and you see that it's spiked significantly. Not quite to where we were during COVID, but really a pretty sharp spike, and perhaps not surprising, given the sheer volume of announcements that we've had over the last couple of weeks, and even prior to that from the Trump administration. Yeah, so you know, having sort of set the scene of this as a little bit of a growth slowdown, I wanted to sort of map out the timeline a little bit. The chart here is of the S&P 500 US Equity Index, and I've put a couple of relevant points on this, and notably I would say that the sort of points that we've highlighted, you know, start before the sort of liberation day of tariffs on April 2nd. In mid-February, we had a weaker than expected retail sales number. We had weaker than expected guidance from one of the big US retailers. And we think that those two events prompted a little bit of weakness in markets even before the tariff announcements, and really speaks to our mind the fact that we think about this in terms of investor concerns around economic growth in the US. And worth remembering that we're talking about concerns about growth from an economy that has done extremely well over the last 2 years, certainly relative to the rest of the developed market. And so you have economic concerns, but really coming from a pretty strong base level. But again, you can see some weaker retail sales data. Then you see a pretty sharp reaction to the tariffs on Liberation Day, where we think investors the consensus view was that you perhaps see a 10% across the board tariff, but you saw that and a lot more in terms of these very high reciprocal tariffs on individual countries. Now, those have been walked back. And so what you saw last week, you saw a pretty sharp market rally on the announcement of this 90-day pause on most of the reciprocal tariffs. But all of this is to highlight a couple of things. One is, as I say, is a growth dimension to this that's pretty important. And the other is that it's, you know, the equity market in particular is reacting quite violently and quite quickly to news flow. And that makes it very difficult, even more so than usual, to try and time the market should you be so inclined to do so. We've seen these intraday moves of up to 10% from peak to trough and vice versa. Which looks appealing until you actually try and do something about it, and it's really extremely difficult. So let me try and put this in a historical context. This is a chart of equity market volatility, so perhaps a measure of risk. And we can see that the sort of latest bout of volatility is certainly not the highest. It was higher during March 2020, and it was even higher than that during the global financial crisis. But this is really a relatively high level of equity volatility compared to what we've seen over the last 20 years or so. And it's interesting, and one of the ongoing debates within the team is that you don't have a huge number of data points, but historically, volatility at this level would be taken as a good opportunity to potentially to buy equities, right? You've seen over the last couple of points that if you bought equity when equity volatility was this high, you in the end were rewarded over the following 12, 24, 36 months. And so that's something that we very much keep in mind as we try and digest the news flow and the macro dimensions and the impact on growth. In the back of our minds, we're sort of conscious that historically, it's been a decent buy signal, and the question is, well, will that be the case this time around as well? The other part that's worth highlighting here, that we've seen over the last week or 10 days is really actually that it's not just about equity markets, it's also about the fixed income market. And we've seen a lot of volatility in US government bonds. What we see here is the difference between the yield on US on 10-year Treasuries and 30-year Treasuries compared to German bunds. It's not a precise comparison. There obviously are currency differences as well, but it sort of captures the picture. And what we see here is that, you know, the initial reaction was that US government bond yields fell, which is something that you might expect to see if you were being concerned more and more about future economic growth. But after that, you saw those yields come back pretty sharply. And there may be some technical market-related reasons for that. But it was something that seems to have concerned the US administration, and was quoted, you know, one of the reasons cited by the administration for taking their foot off the gas a little bit with regard to tariffs. And there can be a few reasons for this. Obviously, that, you know, the administration has been very focused on bond yields, particularly on the US 10-year yield, which is, I guess, in their minds where they think of their funding cost. The second part is that tariffs are only one part of the US government policy. They have hopes and expectations that they will bring in a budget that will cut taxes, that will potentially raise the fiscal deficit further. And they need to make sure that they can actually fund this, so that the financial markets will provide the necessary financing for that. So the US fixed income market is very much a focus of attention for investors. So it's not just an equity market story. It's also very much a fixed income market story, and something that we continue to keep a close eye on. And just to put it into context, this is a chart showing the 5-day change in the US 30-year yield. And what you can see here at the far right of the chart is that the 5-day change in the yield as through Friday is the highest that it's been in the last 25 years. So again, a pretty sharp move in US fixed income. And at the same time, we've also seen the dollar weaken, particularly against the euro, at the same time as bond yields have been rising, which is a slightly unusual situation for the US market. Again, a lot has been talked about the weakness in the dollar. If you look at this chart, you can see that, you know, relative to it's certainly sold off in the last couple of weeks, but it's still sitting within the band that it's been trading in more or less for the last couple of years. So again, another focus of attention. Here, the administration, at least, is a little bit conflicted. They like the idea of the US dollar continuing to be the reserve currency, but at the same time, they very much would like the dollar to weaken relative to its trading partners as a way of improving the trade balance. How you quite square that circle is not immediately clear, but there are some perhaps competing priorities for the administration, even allowing for the fact that it's not straightforward for a government to actually directly impact its currency in the way that they might like. And then lastly, sort of, you know, what is all of this about? On the fixed income side, this is a forecast of US government debt from the Congressional Budget Office. And what you see is that on the current trajectory, we should expect to see a meaningful increase in debt to GDP over time. You're not where you know, for instance, where perhaps Japan is today, but if we saw no change to US policy, this is the current official forecast of where debt to GDP might go. And so when we think about volatility in markets and volatility in fixed income markets, at the back of our minds, this is a question around the cost of financing this particular deficit. So what I want to leave you with there when we think about tariffs is that it's not just about tariffs. Tariffs feed into growth, feed into fixed income markets as well, and feed into the government's ability to finance its deficit at an attractive rate. So there are a bunch of moving parts here that build on tariffs, but also, you know, go well beyond it. And those are things that we need to think about when we think about, you know, the outlook for markets going forward and how we think about constructing portfolios in that sense. So let me talk a little bit now about portfolios, about how we're positioned, and about the things that we kind of think about. I guess a couple of things to say first. The first is that obviously this isn't the first time we've had to deal with market volatility. We've been through COVID. We've been through, for instance, last year where there was a lot of market volatility in the summer around Japan, and then going back further in time to for instance to 2018. So this is a fact of life in financial markets, and it's something that we think about, that we prepare for as best we can. But the first thing probably is to remind ourselves that it is normal, that it is a kind of a feature of financial markets, and that we will get through it in some point, and that we need to maintain kind of the long-term focus of the portfolios. The second part is that what the first thing that you really do when market volatility picks up like this is you think about your current positioning. And we ask ourselves the question, okay, where are we comfortable? Where are we less comfortable with our positioning? And we, for instance, may use some internal benchmarks to say, well, how are we positioned in terms of the overall risk of the portfolio, in terms of particular asset classes or particular exposures, and really asking ourselves the question, is there something that we need to do immediately here? And so when we think about where we came into this on April 2nd, we'd reduced our equity exposure a little bit in early March. And so we came into this thinking that we were relatively conservatively positioned, not very conservatively positioned, but on the margin, we thought we were quite conservative versus our internal benchmarks. It's not quite the same as saying we won't, the portfolios, particularly the high risk portfolios, won't go down when equity markets sell off. But again, when we think about the exposures we have, we think about the risk that we're running, we were pretty comfortable with where we were versus where we were expecting to be. And that's important, because there could have been a situation where we felt that we needed to take some action quite quickly to address particular positions. Happily, that hasn't been the case. The next part is to think about the different scenarios, right? What we know is that the volatility has been pretty high. I mentioned the intraday moves on equity markets. So there, when you see these kind of 5 to 10% moves intraday, it really discourages you from acting unless you're very uncomfortable with the positions that you have, or unless you think that there's a really compelling opportunity, because that pricing can move around so fast. So for us, it's really taking the opportunity to take a step back and think about, okay, what are the long-term variables that we think really matter here? If growth is going to slow, how much do we think it will slow? What do we think will be the impact on corporate earnings? And what do we think is currently priced into financial markets at this point? All of these are forecasts, right? And so it's inherently A, impossible to know, and B, a significant challenge. That's particularly true for trying to assess what we think is priced into markets. That's not something that you can inherently know or that you'll kind of ever see. But nonetheless, we think it's important to try and understand what we think the impact will be, feeding from the macro to the corporate earnings and the corporate fundamentals, and then translating that back into valuation. And so that's a chunk of the work that is ongoing, that is always ongoing, in terms of thinking about what are the levels at which we would be tempted to buy, the levels perhaps we would be tempted to sell for different asset classes. And it's important here to be flexible, not to come in with any kind of prejudgment as to what the next move should be, because again, it's going to be driven by valuation and by market movement and by where we assess value to be. On this particular point, though, we think it's pretty important that, to highlight diversification. We obviously talk about diversification a lot. We have a pretty broad toolkit in terms of being able to gain exposure to different asset classes and different geographies. But at a time like this, really being able to use a broadly diversified portfolio, we think is critical to be able to, protect portfolios from volatility, but also take advantage of opportunities that potentially begin to show up. So we spend a lot of time thinking about, about the current situation, but then we also think about these longer term considerations. And in that sense, again, tariffs are another manifestation of it. And some of this is really around geopolitics and the way in which geopolitics can impact portfolio construction. right? How do we, obviously we've seen a new administration come in. It's made some significant statement changes potentially in terms of how it addresses its partners, its allies, kind of global financial system, global trading system. We need to think about the long-term implications of that. Where will there be winners? Where potentially will there be losers? And how should we adjust portfolios to reflect that? That might mean, increasing the currency diversification. It might mean increasing the geographic diversification. It could also create opportunities in particular industries that we can look at. So again, we have this broad toolkit. There's a lot of change coming, and with change, there comes a lot of opportunity potentially. And those are the things that we're currently thinking about. So as I say, we came in, we thought relatively conservatively positioned. We haven't felt the need to make sharp knee-jerk changes to the portfolios, but we continue to look at the right levels in which at which we should act, either to buy or to sell and reduce some positions. So with that, I'm going to stop and turn it over to Chris.
Yes, thank you, Richard. Again, we will come to questions. I'm sure there's plenty for Richard and the positioning. I just wanted to say a few words about, okay, this is all well and good, what's happening, but what should an investor do? And so, someone's requested captions. Hopefully that helps. Whoever requested the captions, hopefully that works. What should an investor do in this situation? And what I've done here is we've had plenty, as you can imagine, of conversations. The team have spoken to many clients over this period and answered a lot of the key questions, and they match a lot of the key questions that people have sent in, which we'll come to as well, but hopefully this will help to answer a few. So the crucial thing, and I've broken this down into a few statements, which hopefully will help to frame how to act. Based in line with what Richard said, volatility is part of the journey. Part of volatility, every time it feels like this is something different, something new, something scary. And obviously Richard's just shown that in terms of scale, it is quite large, but this is a chart or a table which shows every year since 1928 of the S&P 500 index. In the left-hand column, labeled DD, is the drawdown. So what was the biggest fall in that year? And then the right-hand column, the TR, which is the total return, that was the end's return for that particular year. What I want to draw your attention to is the left-hand column. Every single year, there is a reasonable drop, actually. And actually, there's many that are 10, many that are 15, 20, sometimes 30%. And it happens on a very regular basis. Even last year, the markets did 25%, the S&P 500 did 25%. But during that period, there was a drop of 8.5%. 2023, 26.5 and a bit percent, 10.3. In the last several years, there have been some big drops. This is not new, and this is part of the journey. And we say it a lot, but I think it's really good to show a kind of visual description of what we're talking about. And the portfolios that we build have this in mind. And I think that's really important, because one of the biggest questions that we always get is, should I be changing my risk level? Should I cut risks? Should I change what I'm doing? And the answer is, well, only if your time horizon has changed. The way that we construct portfolios is on two things. One is, many things. Sorry, the way that we allocate you to your risk level is on two main things. The first one is your attitude to risk. So we take that from the risk questionnaire, and that will always bound and frame the scope in which you can invest. But the second one is, how long is your time horizon? How long are you looking to invest for? What age are you looking to retire? All the questions that we ask during that portfolio construction are exactly for this purpose. So what the chart here shows, and this is taking basically bond and equity returns since 1970 and kind of charting different time horizons. What it shows is with less than a year, so 1 day, 1 month, 1 week, short time horizons, regardless of where you are, generally 40% a chance of coming out at a loss over a very short time horizon. But as that time horizon increases, you tend to find, different asset mixes will, the risk will come down with different speeds. So again, right at the bottom, 25% equity, 75% bonds. After 2.5 years, that's only just above 5%. again, this is history, so obviously not a guarantee of future performance, but it doesn't factor in where markets are, what's going on, because volatility is everywhere. As we remember here, volatility happens all the time. This is factoring in the fact that volatility. And again, for those in 100% equity, fine, it takes a bit longer to come down, but after 5 years, you're still, you're below 15%. And the point here is that we factor, this is why we build the portfolios. So the reason to change risk is because you've changed the volatility, not because of the situation you are in. So change of time frame, not the situation you are in, excuse me. And so people could tend to say, well, okay, well, why don't I just change risk for a bit and then I'll change back, I'll kind of cut risk a little bit now and then maybe I'll add a bit when markets are a little bit better. And we hear this a lot, but what that essentially means is I'm going to, take my losses while the markets are down and I'll buy again when markets are kind of back up again. Or, I'll just take it into cash for a minute and then go back in. And what we found is that's always very, very detrimental to your long-term outcome. So here we have a chart. And again, if we look at the blue one, this is the chart of the essentially global stock market between the start of 2012 and the start of this year, 2025. So 13 years in that sense. And basically what it shows is over that 13 years, if you've invested in the global stock market through this particular ETF, you'd have got about 440% return. If you'd have missed 3 days in those 13 years, 3 best days, and I think somewhere around 4,700 days in total, maybe just over. If you've missed the 3 best days, you lose somewhere around 60 to 70% in total return. So you drop below the 400 mark. If you miss the 10 best days, you drop down to 300%. And again, this is, across 4,800 days, missing 10 best ones. And 30 best days, you see the red line at the bottom. And the point is, these best days don't come, there's not a big sign saying, hey guys, invest tomorrow, unless it's Donald Trump and he's announcing now's the time to buy, but that's obviously slightly different. But these ones generally always happen around the worst days. And again, I joked about the day last week, but that is a perfect example of amidst chaos, there's suddenly a day where there's 10%, 12% growth in certain equity markets. So the point being is that we see it so often where clients on the way down, they'll be so nervous about losing anymore. They don't want to, they want to cut their risk. And it's a natural feeling, and we'll get onto that in a minute. But what that means is you then miss a lot of the best days in the markets because they come relatively close to the worst days, and the results is detrimental. So again, build a plan, understand the risk you're in, and don't try and get too clever with it, because that's where you tend to really suffer with these things. Jumping around too much, using the current situation as the reason for the risk level is a fool's game, unfortunately. It's very difficult to get right. And here we have, again, it's another example. It's a little video that we've taken, but it's a really good one. That, had you cashed out at the bottom of every, it's a bit jerky, if you cashed out at the bottom of every situation, what would have happened? And kind of long story short, if you'd have then put it into cash, long story short is you kind of end up with less over time. I feel like that's a little bit jerky. It will be in the slides when we share it afterwards. So we'll just give that a miss, but I think you get the point. And what does that all ultimately culminate in? Ultimately, it all culminates in the average investor historically underperforms. Then again, this is nobody, this is taken by a completely different set of data. This is Morgan Stanley, who set out this analysis between 1997 and 2017. So this is the 20-year time horizon. Again, past performance of those particular asset classes are not an indicator of future performance, but what they assessed during this period is what did average investors hold? Where did they change? What changes did they make? And unfortunately, the changes that they made resulted in them missing jumps, catching downsides, missing the best periods of different asset classes because they keep jumping around. And why is that? because we're human, you know, it's the emotion of it. It's so hard. It's so easy for us to sit here and put some numbers on the screen and say, oh, you know, don't do this, don't do that. But I think we're supremely conscious at Moneyfarm that yes, we look after your money, but it's not numbers on the screen that we're looking after. It's a dream retirement, you know, with lots of holidays with the grandkids. It's your first home, you know, first place you can call your own home. It's the ability to send your children to a school you wanted to, or save up to help them with their first home. We're not dealing with numbers on a screen on the day. Well, we are, but at the same time, we're also dealing with people's goals, people's lives. And I think it's that emotion that comes in for humans, which then causes a lot of the what we call behavioral biases. So, you know, I don't want to make any more losses. You know, people having what they call loss aversion, where they, you know, value gains much less than they want to avoid losses, or even greed, you know, when markets are on the up, increasing risk at the wrong periods. So long story short, you know, try best as possible to take the emotion out of it. Obviously, it's difficult. I really appreciate that. But these knee-jerk reactions can be really, really costly in the long term, because those are the ones which end up, if you don't stick to the plan, you keep jumping around, can actually have detrimental effects. And then obviously be diversified. Again, I think, you know, I've used so far this year, I mean, the pink one, and again, up to the 8th of April, the pink one is bonds, the global, you know, government bonds, global government bonds. The red one is global stock market, and the black one is the NASDAQ, so essentially US tech. You know, 6 months ago, people are piling into US tech because it's the best thing that you could do, and now it's the worst thing you could do. And I think the key is, again, stick to a plan. Stay diversified. Again, if you're 100% equity, great. Stay diversified within the equity. If you're mixed, as we've shown previously, stay in that kind of mixture. But don't kind of jump around trying to catch the latest trends. Just be as diversified as possible. Historically, this has always shown to kind of be the best outcome. So, just to summarize, volatility is part of the journey. You know, it's happened in every year in history to actually quite large extents. And every time it does happen, it feels it's tough, it's difficult. You know, numbers are red on the screen, values are going down, but it is part of the journey. And it, you know, it will happen again in the future. We factor that in when we put you into the risk level you're in. So again, stick to the time horizon, stick to the plan. Time in the markets is difficult, and it's generally detrimental. Try and take the emotion out of it. Try and take the emotion out of it. Be diversified. And last but not least, but just as importantly, talk to us. We are here. We have a very qualified, very friendly team, very happy to speak to people. We've spoken to a lot of people over the last couple of weeks. I think the feedback has been very, very positive. People have felt much more at ease, whether it's getting kind of guidance on your own situation, whether, you know, there's anything changed, you want to see what that change is relevant, or just understand a little bit more about what we're thinking, to understand a little bit more about the markets, the impact on your portfolio specifically. Speak to us. We really, you know, it's a free part of the service. It's part of the service that we really kind of value, the ability for people to access us, call us, chat, email, or book an appointment. There's a link here. We'll send it out, or, you know, you can always find it on the website. So yeah, hopefully that helps to address, and again, hopefully address some of the questions that we've already had, address many of the questions that we've received during this period. But I thought those were kind of very valuable in that sense. So we'll now kind of move to the Q&A. So again, thanks for all the questions so far, and thanks for the questions in advance. We'll start with probably some more general ones. And again, a lot of these came through at the beginning or beforehand. Should I change risk level? I think hopefully we've addressed that one. But again, only change, I think, changing risk level, unless you're supremely uncomfortable with the volatility that you face. And again, this shouldn't, you know, the risk level has been misunderstood at the beginning, then that's well worth speaking to us to understand. But only change it if a plan is specifically changed, I would say. Because again, if your time horizon is really short, perhaps we shouldn't have been invested in the first place, but that's equally as true when markets are going up as it is when markets are going down, because things can change quickly. So hopefully that's answered all those questions. But again, speak to us if it's not sure. Is now a good time to buy? Is now a good time to invest when you have cash? Someone's just sent it through, but it came up a lot as well. It's time to add to markets. Again, I mean, I don't think we can sit here and tell you what's going to happen over the next month. But again, it depends really on the time horizon that you have, your risk appetite. But if you have a long-term time horizon, the key kind of thing is to keep contributing if that was your plan initially. I've always find people are really happy to add into markets when prices are higher than they are when prices are lower. And again, it's that feeling, it's that sentiment, it's that emotion. But logically, you take a step back, and if you have a long time horizon, keeping contributing while you can, when you originally intended to, as part of a plan, these lower market periods definitely are a buying opportunity in the long term for sure. And I think, if that was originally part of the plan, continue to do so for sure. Then there is some more, let's kind of current market conditions. We get this quite a lot actually. What are the prospects for ESG?
Yeah, so I mean it's super interesting, and I guess I would divide it into two parts. The first thing to say, as we sort of said before, is that the outlook for tariffs is still pretty unclear. But I guess I'd say two things. The first is that in a broad ESG portfolio, we wouldn't expect there to be a kind of a really significant difference. I guess the real question that you end up asking is do we think energy is going to do better or worse than kind of non-energy, because that's the one of the main areas where an ESG portfolio will have less. Tough to say. If we saw a real slowdown in growth, then potentially you see the oil price come down, as you have done, and that will impact the earnings of energy companies. But by the same token, growth can have a kind of a more meaningful impact on non-energy sectors, and so it becomes quite a difficult call. But at the end of the day, when we think about broad ESG portfolios relative to our classic portfolios, it's not clear to us that we should see a material difference. When you're thinking about perhaps the more thematic part of ESG, where you have, for instance, more direct exposure to clean energy or electric vehicles, where a lot of the supply chain is running through China, then potentially there it becomes, you might see some more of a direct impact depending on where tariffs end up settling. And that could create perhaps more earnings volatility in some of those thematic baskets in the short term than you might see elsewhere. So as I say, from a broad perspective, it's not clear to us that we would see a material difference. But within some of the more targeted thematic baskets, then potentially there you perhaps have more earnings risk from tariffs, as they are today at least.
Brilliant, thank you. And now the questions are flooding in, so brilliant, thank you. There's one here about US. So I think, we have actually we have had a big allocation to the US in our portfolios for a long time. Obviously, it's done well for us in the previous periods. Is now a period where we would address that a little bit more. Again, we did cover a little bit of US, particularly in the 100% equity portfolios recently. But what's our view going forward?
Yeah, so it's a really interesting question, and goes back to the sort of final point that I made about the long-term implications of some of what we've seen in terms of global policy making over the last few months. We are, when we construct portfolios, to take a step back, we generally are following a market capitalization weighted approach, and we've seen the weight of US equity steadily rise over the last few years, and to a large extent that's driven by the earnings power and the innovation from some of the large tech companies that are listed in the US that have all of this global exposure, and we're all familiar with those names. So I think going forward there are kind of a couple of considerations. The US, as we know, has trades from a valuation perspective, it trades at a premium to the rest of the world, and it does so partly because it's generally shown much stronger earnings growth, but also because there's somehow an expectation that US companies will continue to innovate, will continue to drive future earnings growth going forward. And the final part about that, I guess, is that we've also seen, the profitability, the aggregate profitability of US equity steadily drift higher over the last sort of 30 years. It is cyclical, so you see that profitability come down as it is for most markets when economic growth is weak. But in general, we've seen the steady drift higher in corporate profitability. And so the question we ask ourselves is firstly, will investors continue to give the US companies the premium that they have done? Will corporate profitability and corporate profit margins hold up as well as they have done? And will we continue to see the sort of earnings growth that we've seen? And it's an ongoing discussion. Clearly, the most recent moves we made have been to reduce our US equity exposure a little bit. There's clearly scope for us to do more if we think that the valuation premium that we've seen is perhaps not as warranted as it once was. Obviously, the geopolitical situation is challenging, but it's challenging on a global basis. So for us, it very much comes down to this sort of corporate profitability question. At the moment, US corporate profitability still looks pretty healthy, but we'll have to continue to see how that develops and to what extent policymakers try to address that. For instance, let's see how what happens with the pharmaceutical industry in terms of the share of profit that they have in the US, and will that come under some scrutiny? The US administration has already made some noises to that effect. So the US trades at a premium. It does so because of the superior profitability and earnings growth that it has generated over the last decade. People have tried to bet against the US and have generally suffered for it. But there are always questions to answer about whether it's going to be able to maintain that profitability and enhance it, which we would argue is where the market is currently pricing, not just high profits today, but even higher margins potentially in the future. So the jury is a little bit out. We continue to have a meaningful position. We have reduced it, and we continue to debate what the right level of exposure is, given not just the geopolitical tensions, but the extraordinary strong track record that US companies, particularly the large tech companies, have had over the last couple of decades.
That makes sense. Thank you, Richard. I think a question we get quite a lot. And I think just to add to that, and you made the point around uncertainty with all the volatility. Nobody knows, obviously one of the key factors is earnings, future earnings for US companies. Nobody really knows what the impact of tariffs is, right? And I imagine that's probably why you're seeing so many wild swings, where some people say, well, there's going to be no earnings growth in the future. Some people say, well, it'll take a little bit off where it was, and that's kind of what's jumping around. Would you say that's the case? I
think that's true. Look, I also think there's risk premia, there's positioning. There, inevitably when you have this bouts of volatility, people who have invested on leverage, or funds that have invested on leverage, potentially face margin calls, and so there's a lot of dynamics in the sort of very short time frame part of the market that needs to wash out, and we think that's some of what we've seen over the last couple of weeks. That's not our investment process. That's not our style, and so we sort of step a little bit away from that. But we do think that the outlook for corporate profitability, as it always is going to come under increasing focus if you continue to see a slower economic activity. What we saw during COVID was that corporate profitability actually held up really well, better than we had expected. And certainly better than you would have guessed if you had looked at the sort of global financial crisis as an example. So it does come back to some extent, at least, to that growth outlook. But what's clear is that these large tech companies have been in a very strong position in terms of their corporate earnings and their corporate profitability. And it'll be interesting to see. We'll have to make a judgment as to whether that's going to deteriorate or not.
Yeah. I'm going to put you on the spot a little bit here. So there's a couple of questions about the intent And I think that probably leads into kind of our view of perhaps where this goes on. But there's one question: if tariffs are designed to encourage more companies to move production to the US, why would companies invest in the US when there's so little stability in the president's actions? And then there's another one: is it possible that Trump might be crashing the markets on purpose? So again, asking you to kind of understand the psyche of the president is always difficult, but I think understanding his intentions probably, and where we think, is this a negotiation strategy? Is this something he truly believes in? What's our house view?
Yeah. So the first part of the house view is to acknowledge that we don't know. Of course, we can't speak to the psyche of the president or anything like that. We can tell you, we'll give a sense of the discussions we have and how we're thinking about it, and and then sort of try and get to some sort of a sense of a conclusion based on what we've seen. I mean, I guess, look, there are a couple of things to say. The first part is that, I think our view has always been, for as best as we can tell, that the whole tariff discussion is part belief and part negotiation, right? So from what we can tell, the president has, from public statements, I hasten to add nothing else, the president has long believed that trade policy or the global trading system has been skewed against the United States for whatever set of reasons. So somewhere along the line, there is a view within the administration and stated fairly openly that they think this needs to be addressed. And you can kind of have an economic discussion about whether that's right or wrong, but that appears to be their view. And so, our conclusion from that is that wherever we end up on tariffs, and we think it will be lower than where we are today, it will still be higher than where we were 3 months ago. And so we need to kind of factor that into our thinking and assess whether, how much of an impact we think that ends up having on economic growth and corporate earnings. And I guess that comes to the, to the question: do we think that the president has tried to drive the equity market down? And I would say, again, I don't know. Our guess would be not. But what we did think we saw was a willingness from the administration to tolerate equity market volatility. In kind of to sustain their long-term policy goals, right? So their long-term policy goal is to readjust the global trading system, to shrink the US trade balance, again, rightly or wrongly, and the equity market, to some extent, equity investors sort of voted with their feet a little bit and said we don't really like that, and up to a point the administration appears willing to tolerate that, and that's why we think you saw much more commentary around volatility in fixed income as being perhaps a trigger for a shift in approach. Now, the president, we understand, is somebody who does look at did in his first term look at the equity market as a representative, kind of a voting mechanism as to the sort of the effectiveness of his policies. So it's not that he likes the equity market to go down, but it seemed to us, at least, that he was willing to tolerate equity volatility for the sake of a new tariff regime that he and his advisors appear to have some faith in.
Makes sense. Thank you.
I gave an answer to that. No, understanding that obviously we don't know exactly what the president thinks.
I think that's fair enough. There's been several questions again before and now around what to do with a lump sum. Should you drip feed it into the markets, or should you kind of put it in now, taking advantage of the valuations? Firstly, there's some reference to the 90-day period of the tariffs. The short answer is I must admit we have no idea ultimately what will happen in that sense. Will it be higher? Will it be lower? Will he extend them further? Will he kind of crack on? It's difficult. So
let me say something.
No, I was going to say I was going to talk more general theory around drip feed versus.
Okay, we'll finish up on that and then I'll answer the 90 days.
90-day point. But in terms of drip feeding versus lump sum, again, it's. Sorry to sound like a broken record, but it's always a question of time horizon. So if you've got 20 years, 10 years, whatever, and you put the money in straight away, or you drip feed it over 6 months and then leave it for 9.5 years, 19.5 years, whatever, is there going to be a material difference outcome at the end? Unlikely. I mean, again, going back to the thing, there's probably you might even miss some kind of impact on markets going up. Having said that, it's more of an emotional hedge in a sense, because if the markets went down after you put a lump sum straight in, how upset would you be about it? And I think that's the real question to answer. Ultimately, long story short, looking at the situation, it shouldn't matter. You know, being in the market, as we described, is better than trying to time it. And again, you might have to accept the fact that in the short term, it might continue to go down further, but in the longer run, it might, you know, you take the rough with the smooth, and there'll be more volatility along the way anyway. So long story short, there's no definitive answer, and perhaps speak to us around your specific situation. The gut sense is that, again, time in the market is better than timing in the market. But again, if somebody feels much more comfortable drip feeding it, it is a way, particularly now that you've got the full allowance for the year, you've got 12 months to fill it. If it makes you feel more comfortable, you know, I'm sure there'll be lots of ups and downs coming in the coming weeks. If that makes you feel a little bit more comfortable, it's certainly a way to do it. So at that point, it's a little bit a matter of preference, I would say. But again, thinking about if you've got a long time horizon, then time in the market is always helpful. Hoping that answers the questions. Again, coming back to the 90-day situation, I mean, would we imagine volatility to pick up around the time?
Look, I mean, I think the 90-day thing is interesting for a couple of reasons, right? I mean, on the one hand, the initial reaction was, okay, here's a sign that you think about this sort of pendulum within the administration between kind of belief in tariffs as a policy versus, you know, tariffs as a negotiation. You know, this was the point at which perhaps it began to swing a little bit more to the negotiation side, and you saw the equity market react to that. You know, I think the 90-day thing, you know, says a couple of things. One, as I said, it speaks to the willingness to negotiate. Two, it also speaks to this point around uncertainty, which I guess is a little bit behind the question, which is, you know, we're not going to have a definitive answer on tariffs. Right, we're not going to be in a situation, it looks like, where they say, you know, here we are, this is the end point, and it's done. Right, we're going to be living, I guess, with tariff volatility for some time to come, and so it's, you know, will there be volatility around in 90 days' time? Really hard to know, and it will probably be driven by, you know, progress that is made on these individual bilateral trade agreements with all of these different countries. You know, if the administration is speaking correctly, then they have, I don't know, 70 trade deals to be negotiating in some way over a relatively short time period, right? To negotiate a trade deal in 90 days is based on history. Those who remember the Brexit negotiations, right, is extremely difficult. If that's really what they're talking about, you know, that would, you know, we would imagine that would take far longer. If there's progress being made, you would imagine the 90 days would be extended, but it's really impossible to know. So, you know, we would expect, you know, to see progress on these trade deals over time. We don't think that they're going to be done in 90 days. You know, sitting here today, my guess would be that you know, in some cases that period is extended. But we will be in an environment, we think, where tariff levels are higher than they were, and where the uncertainty as to the precise level of tariffs and the precise nature of trade policy is going to be higher. And so that is, you know, potentially challenging for investors going forward. So it's not necessarily about 90 days per se. You know, it's about the nature of the negotiations and the impact that has on certainty and comfort for markets going forward.
Brilliant, thank you. And it's a question here from John. We've spoken a lot about the effect of US tariffs. Obviously, it's very prevalent in the mind, in the media. What about the effect of wars? Kind of Ukraine, Israel, etc. What's our view on that?
Yeah, I mean, so I guess a couple of things to you know, to say, thinking about the, you know, leaving aside the sort of the human element, because we don't have anything kind of unusual to say about that beyond the fact that it's all awful. So there are a couple of things to say from a kind of from a macro perspective. The first is, what we said at the original, the time of Israel-Palestine was the macro impact depended a little bit on whether it's remained localized or whether it regionalized. Broadly speaking, it hasn't regionalized in the way that we think would have had a meaningful impact. The caveat around there is obviously around the Straits of Hormuz and around oil flowing in and out of the Gulf, and that has had an impact in terms of shipping, and that's been meaningful. But at the same time, you haven't necessarily seen that, we think, reflected in oil prices, certainly where they are at the moment, to any meaningful degree. In a similar vein, I guess, the potential macro impacts from Ukraine are perhaps a little bit greater, particularly for Europe. On the one hand, potentially you've seen European energy prices higher than they would have been without this conflict. And so if you saw a resolution to the conflict that involved a relieving of sanctions to some degree, potentially there's a benefit to Europe in terms of lower energy prices. I say potentially, perhaps in terms of soft commodities as well. There's a lot of discussion actually in both regions as to whether there could be a construction boom as a sort of a reconstruction period if you did see peace. So there are some potential peace dividends there. I guess the other part that's very much in focus at the moment is European rearmament is a bit strong, but Europe, increased defense spending in Europe, encouraged both by the conflict in Russia, Ukraine, and also the sort of pressure from the US administration for Europe to increase its defense spending. So we are seeing perhaps more of a macro impact or potential macro impact from Russia, Ukraine. And that is, ongoing and potentially, translates into higher European debt levels, sovereign debt levels. Obviously, Germany well placed to actually spend that money given its starting debt to GDP, and potentially faster European growth as well. And might become particularly relevant if you're a vehicle manufacturer who faces significantly higher tariffs in the US. So there are a number of sort of macro components, but one of them potentially is that they can translate actually into a reacceleration, at least on the margin, of European growth. If you, as I say, driven perhaps by lower energy costs, if you did see some sort of a ceasefire in Russia, Ukraine, and potentially increased fiscal spending on infrastructure and defense over the coming years.
Makes sense. I think there's a good one here, which is kind of a good one to round off. I think now is good. And how often does Moneyfarm review the investment strategy, in response to global events? I think it's good to kind of pull back the curtain a little bit, whilst all this is going on, what's our kind of day-to-day process and how do we look at this?
Yeah, so look, let's unpack it a couple of different ways. So it's not quite what was asked, but let's say, look, from when you have periods of volatility, and Chris was talking about emotion and everything else, and how do you sort of manage that? How do you sort of deal with that? How do we deal with that? Look, our starting point is that we have somehow a defined sort of philosophy and process about how we think markets work, what we think is the best way for us to invest. There's lots of ways to invest, but the best way for us to invest on behalf of our clients, which is long-term focused, relatively low turnover, thinking in macro terms rather than about individual stocks or companies or individual kind of credits. We question ourselves as to whether that's still the right approach, on a regular basis. We still think it is, but it becomes extremely helpful during periods of volatility because it somehow provides a roadmap, an anchor, call it what you will, to you say, well, this is how we think we should behave. We've defined this almost before the volatility in other time periods, and we think we should stick to it. And so having that underlying philosophy and process, we think is really important, as a way of managing, whatever behavioral biases we might face. In terms of kind of on a more immediate sense of how often do we review the positions we have in the portfolio, that it's on a daily basis. I would say even more so during periods of volatility, because what we have is a sense as to where we think value is across different asset classes. And what that volatility means is that if you think you have bands, right, you have a band at which you would buy something, a band at which you would sell something, volatility means that you're more likely to hit those particular points and feel the need to do something. It can get too volatile. We saw that for a day or two last week, where even if you had a buy signal or a sell signal, you were you almost couldn't execute at that point. But in general, I would say it's really a daily process, thinking about whether the positions we have in the portfolios are the right ones, and whether we should make changes. I would say, as you see, because we don't make a lot of changes, the bar for us to act is relatively high. But during periods of volatility, you're more likely to get opportunities, and so we've continued to look for entry points for us to buy things that we think are interesting. But it's a constant process.
Brilliant. Yeah, thank you, Richard. And yeah, thank you everybody for your questions. And I think we managed to get through the full Q&A, particularly with the guys at home. So well done, everybody. So yeah, thank you. I think we'll wrap up there. Thank you all for your time. We will distribute this afterwards, again, so you can rewatch any parts. We will continue to release more content throughout this period, particularly in slightly higher volume than normal, just to keep a sense of where we are, what we're thinking, and hopefully keep everybody in the loop. But once again, I actively encourage you, if you want to, please speak to everybody. Speak to us, speak to our team. We're constantly available, and we're always happy to help. So please don't be afraid to do so. But for now, thank you very much. Have a fantastic evening. And yeah, thanks very much again.